Hi, my name is Christine Kesser. I'm going to be working through exercise E11-1 with you today, straight out of your textbook. We're going to be looking at a truck purchase for Lambda Company that was purchased on a note payable with a maturity of 1 year and the related transactions. So I set this up in Excel for us to make it a little bit easier. Here is a screenshot of the question out of your textbook. So record the following note payable transactions in the company's general journal. So June 1st of 2019 was the purchase of the delivery truck costing $86,000, and we purchased that by issuing a 1-year 6% note payable. So our very first transaction here, or journal entry here, will be related to the purchase of the truck being an asset. We need to create an asset account and for this truck, and then we need to post to a liability account for the note payable. Always enter your debits first and then your credits. So let's begin by choosing our first account name. The debit in this case is our asset. It is the delivery truck. So where it says account titles and explanations, we would just say delivery truck as an asset account, and we would debit the $86,000. And then to offset this with a credit, the credit is the note payable. We would call that note payable short term because it's being paid off within a year. And we would credit the $86,000. So that would be the purchase of the truck on the note payable. So that handles our very first entry. Now on December 31st of the same year, we want to accrue the interest that we've accrued up until that portion. We're not ready to pay this off yet, but we do at our year end of December 31st want to accrue for the interest that we have owing on this note payable. So we first have to do the calculation. We know that the truck is $86,000. We're going to multiply it by 0.06. That is the interest rate annually. Always remember that our interest rates are annual, and so when we're accruing, we're actually looking at a period of time that we're accruing. In this case, from June 1st to December 31st is 7 months out of a year. So when you have, and the $5,160 that we have on our calculator here is what we're actually going to pay for a full year. However, we only want to accrue from June 1st to December 31st, 7 months of the year. So here we would multiply this by 7 divided by 12 and get $3,010. So we can accrue $3,010 worth of interest at December 31st. How would we record that? For December 31st, again, we want to enter our debit first. So we know that when we're accruing interest, there's going to be an interest liability account and an interest expense account. And the expense account is the account that we would debit. So we start there. So we use the interest expense account as our expense account that we are debiting with $3,010, and interest payable, $3,010 credit. So here, this is just an accrual. The actual interest will be when our loan is mature, and that is our third entry. On June 1st, 2020, we're going to pay the note payable at maturity. So how do we record that? We know that to pay this, there is going to be cash that's going to be paid out, and that's a credit to cash. When our cash is leaving our bank account and our pockets, that's a credit. So the debit side is going to be a little bit more lengthy because there's a couple of things that we want to do. So far, we've said that there's an interest payable of $3,010. We actually have to wipe that out, and then we're going to expense the remainder of the interest because so far we've expensed $3,010. What we want to look at is how much interest are we owing at maturity. We kind of figured this out before on our calculator, but let's go ahead and do that again. Now that the loan has matured, or this note payable has matured, and we know that it was for 1 year, we can just simply use the annual interest rate. So it was $86,000 multiplied by 0.06. $5,160 is the amount of interest that is owing on this note payable at its maturity, which is what we're doing right now. So I've done a little just calculation off to the side here. So our original note is $86,000. And we know that after a year, we're paying the full interest of 6%, $5,160. So we're going to end up paying right now on June 1st, 2020, $91,160. So we know that that is a credit from our bank. We're going to be paying that out. But what are the associated debits here? Well, one thing that we want to do is wipe out the notes payable. It's no longer payable. We're just going to pay it off. So if you look in the previous June 1st of last year entry, we had a note payable of $86,000 credit. We now need to debit that and wipe that out. What else? Well, we have accrued interest payable of $3,010. We also want to wipe that out. It's no longer payable. So we start there. We debit interest payable by $3,010. Then we take the difference of the $5,160 of interest that is actually payable on the loan, and we deduct the interest that we've already accrued of $3,010. So I've done this little calculation here. Here's the interest payable on the loan less the amount accrued. So there is a difference of $2,150. So we're actually going to have to expense that as interest expense. And then of course the offset to this is cash. We are going to say cash here, we're going to enter cash, and we're going to credit cash for the full amount of $91,160. And that concludes how to do the entries for E11-1 in your textbook. Thank you for joining our YouTube channel. Have a great day.